Hello, everybody. Welcome back to Built for Life, Not Just Wealth. My name is Ryan Burklo, and on today's episode, we've got a mentor of mine who's, I'll call him a genius around retirement planning, around taxation, who's taught me a ton in this industry. It's Bob Kievit, who's on the show today. He's been in the industry, and I'm going to make the joke, but it's also the truth. He's been in the industry for 46 years. So as long as I've been alive, and he is, correct me if I'm wrong, Bob, you read the book on IRS, if I'm not mistaken.
Yeah, yeah, many years ago, had to read through the code for a program I was involved in, which one of the boringest reads you could ever have. And I'm not gonna sit here and say I read the entire thing either, but I did read a fair amount of it. So,
So,
uh,
so we've got Bob on the show, like I said. So, Bob, I'm so happy you're on the show. I appreciate your time today.
my pleasure.
So,
Happy to be here with you, Ryan.
so Bob, you've been in the industry for a while, as I've mentioned, and everyone that we deal with and talk to tends to be in the tech space, and they're trying to put money and build wealth in different spots. A huge spot that they tend to have is money in stocks within their company, as
Mhm,
well as their 401ks, the standard uh, American, I guess I could say it out there. But in the end, their whole reason they're saving money is to hopefully one day turn on an income stream.
mhm,
But the issue that you and I see all the time, I think, is the advisors out there and in these people's lives that tend to just focus around the investments and really kind of stick in that rate of return asset allocation type of model. And they don't get any more deeper or analytical in terms of like, hey, how you to turn on the income stream when you
mhm.
do want to retire? Let's just focus on the rate of return. And I'd love to hear your thoughts on that. Like, agree, disagree on that? What are your thoughts?
Yeah, absolutely. I mean, having done this for a long time and really watched financial planning kind of evolve. I mean, I started back in the late '70s, and we didn't have computers back then, and most financial planning was done with a legal pad and a four-function calculator, so it wasn't real robust. uh Most of us didn't have degrees in finance, or we weren't mathematicians, so the math was pretty simple. When we got the computers, the math didn't change all that much, really. We simply took what we were doing before, threw it into a computer. Over the years, those outputs have become prettier, color charts and graphs and things like that. But the methodology for most financial advisors hasn't really changed all that much. Interestingly, I was talking earlier today to some people about results. The way results are measured in our industry, with success rates for people at retirement having cash flows close to what they had before retirement. And you'd think, with 4.5 decades of financial planning, growth, and computerization, and now AI, that the results would be way, way better now than they were back then, and they really haven't changed at all. Um, and a big part of that is that the industry that we're in, the institutions, they hire people to go out and meet with clients and collect their assets and manage those assets. And that's how the institutions, to a large extent, get paid. And so they train their advisors to do that kind of work. And there's nothing wrong with that. I mean, clients, people very often benefit from the expertise that we gain over the years in working with people's finances. But unfortunately, that's kind of the limit to what most institutions train their advisors on. And there are other things besides how much money am I going to have at retirement that are important when we retire. How much I have, the amount of wealth, is going to be really important, obviously, but it's only one of six really important factors. And most people aren't working with the other five factors at all, or certainly very, very little. Um, if you'd like, I can kind of go through what those are, and maybe, taxes is always a big topic. So we can maybe spend some time talking about taxes a little more in detail. But, the amount of wealth, as I said, is important, but protecting the wealth is important. protection is kind of a boring topic, and it involves insurance and stuff, and nobody really loves talking about that stuff. I don't really either, but it is important, because if somebody has worked hard to build wealth, we want to make sure that it doesn't go away. And if they have a lifestyle, we want to make sure that doesn't go away. So we want to protect where that is now, and we also want to protect the future of it, to make sure that if something goes wrong, they're still okay. Future wealth, really, if you wanted to kind of categorize future wealth and describe what it actually means, it would be all of the dollars that we're going to touch in our entire lifetime, assuming nothing ever goes wrong. And then if something does go wrong, we want to kind of recapture what we otherwise would have lost. So that protection component is important, and it needs to be paid attention to. And some advisors do that as well. But there are some other things too that we need to pay attention to. And if it's okay with you, I'm going to put a tool that I use all the time. And I know you use it too. So your people may have seen it before, but let me just put this on the screen here. You can see my screen, right?
Nope, you need to share your screen.
I need to share it again. Okay.
Yep.
Sorry about that.
No worries. But it's really funny. You brought up, a lot of advisors, again, they're focusing in the investments and they do a great job of it. And, to the purpose of building wealth. But what's really funny is I don't know how many people that I sit down with that are in their early 50s or even in their like early 60s. And the biggest topic on their mind is, do I have enough money so that
Mhm.
I don't outlive the wealth? And really what they're wondering is, how much income stream can I turn on and have a high success of not outliving that wealth? And that's a piece that's not getting spoken into, because the only thing they speak into is, well, if you get a 8% rate of return, right? That's their magical formula,
Mhm.
is always in that rate of return, rather than the strategic aspect that we speak into all the time.
Yeah, and again, rate of return is really important, and we work hard on that with our clients, just like any other advisor would. It's an important piece, and we got to focus on it. It works differently in retirement than it does when we're in accumulation. So
Right.
the impact of a fluctuating market affects us differently when we're growing wealth than when we're distributing wealth. So there's an issue around that. But again, even if we get the rate of return and we build up a big pile of money, it doesn't mean that that pile of money is going to work efficiently for the client. So there are other things that we have to pay attention to. I think to really understand those things well, you have to take a minute, as you were talking about, to think about what are the goals
Yep.
of that pile of money. Like, what do we really want that pile of money to do for us? And there's a few things that I think are common threads with most people. There may be some additions to this list, but for most people, what they want that wealth to do is they want it to create cash flow in retirement, and they want to have the highest cash flow that they can possibly have. There's a lot of effort in our industry with financial advisors to try to figure out how much wealth a person will need to create a certain level of cash flow, a certain level of income. And I've always found that to be somewhat of a waste of time to go through that exercise. It doesn't seem like it is, but it kind of is, because there's really no way to know how much cash flow we're going to need, because there's too many variables that will happen between now and retirement. And then there's a ton of variables that are going to happen during retirement. So predicting a dollar amount is really difficult, and then taking that difficult number and trying to convert that into a lump sum amount of cash we're going to need, it's just not a very effective way to do it. We're either going to guess too high or too low, and there's problems with either one of those. I think a better way to do it is to try to figure out what's the optimal amount that we can create. What's the highest amount of cash flow that we can possibly create for somebody? And let's figure out how to get there. Certainly optimizing that cash flow, maximizing the cash flow is one of the things we want our wealth to do. The second thing is, we know we're going to have to pay tax, but we don't want to pay a lot of tax. Nobody likes paying tax. That's one of the, I say that's probably 100% universal from all the people I've met in my career. Nobody likes paying taxes. Nobody wants to pay more than they have to. Everyone would like to pay less. And so when we structure people's wealth for retirement, we not only want to set it up for high cash flow, but we also want to set it up for low tax and low tax rates. And it's funny, I've heard so many people over my career, advisors, CPAs, tell their clients that, hey, you want to be in the highest tax bracket possible when you retire, because that means you got a lot of money coming to your house. And that kind of seems to make sense, but it doesn't really work that way. You can have a lot of cash flow and still at the same time reduce the rate of tax. And so we spend a lot of time working on those kinds of formulas for people. So high cash flow, low tax. As you said, we never want to run out of money. I've seen a lot of surveys over the years of people who are getting ready to retire and what are the things they're afraid of. And of course, there's things like, well, getting cancer or ending up in a nursing home. But it always seems in these surveys, the number one thing that they fear is running out of money. Nobody wants to worry about running out of money. And so we want to make sure that whatever wealth we have, not only does it give us high cash flow and low tax, but we also never run out of money and still hit whatever legacy objectives we might have. A legacy varies a lot. We have some people who, they're just so dedicated to their kids. They want their kids to get everything. And then we have other people who they love their kids just as much, but they really don't want to leave their kids a lot. Some people want to leave to charity or nieces and nephews. Some people don't have nieces and nephews or children or spouses to leave it to. So legacy varies a lot. But if a client does have a legacy intention, we want to make sure that their strategies can also meet that. And then, of course, we want to be able to do all four of those things: highest cash flow, lowest tax, never run out of money, hit our legacy objectives. We want to do all four of those things with minimal dependence on the market. And I don't mean we shouldn't be in the market in retirement. Of course, I'm going to be in the market when I retire. I'm not going to be all in, but I'm going to be in. But I don't want my success in retirement to depend on what the market does. I want to know that whether the market's up or it's down, whether it's up for a long time or down for a long time, I'm going to be okay. My strategy is going to work no matter what. And so with those objectives in mind, now we have to start looking at the formation of the wealth, the structure of the wealth a little differently to make sure that it can accomplish those things. And again, the amount is important. And on the screen, I just have an example of a balance sheet. We also have cash flow and protection in there. And that's, we'll talk about those separately. But the balance sheet itself, this is somebody who's not at retirement now. This is a 40-year-old working towards retirement. But these numbers are going to grow, hopefully to a lot of money. We want that big pile. But another factor that's going to be important is where that money is actually located. The location of wealth is critical because each of these different areas, and we're pretty deliberate about coming up with these categories. These are not arbitrary categories. These are formulated because they have very specific differences in characteristics around things like, do they or do they not create cash flow? Are they liquid? What do they create tax, et cetera? I can have two clients that have the exact same amount of wealth, but one of those clients is going to live way better than the other, not because they have more, but because it's located more effectively. So, people see their balance sheets or they see lists of their money and it kind of looks like this, and that's nice, but it's a little hard to tell proportionality from just looking at numbers. So for example, if we go to a different view of this, we can look at kind of the proportionality of those slices of the pie. And that same wealth looks like this when you put it in a pie chart with proportionality. Like this is 29%, this is, 38%, and so on. And it's important because if this couple was retiring today, for example, some of their wealth is their personal property, their furniture, their cars, their clothes, that kind of stuff, which is nice. Those are good things to have, right? We need those things. But unless we sell them on eBay, they're not going to really
I don't think
create
they want to.
wealth.
Yeah, exactly.
I always tell clients, you want to have those things because this vision of a bunch of old people sitting on the floor naked with no place to go doesn't really appeal to me very much. So you want to have those things, right? But again, it's kind of a dead asset because we're not really going to convert that into any kind of cash flow for our retirement. So
Yep.
again, good to have, but maybe not going to do a lot for us. Some clients have businesses. A lot of our clients do. This client doesn't, but there's a whole other conversation we need to get into with our business owners on exit planning strategies and how to position their balance sheet so that it's prepared. The balance sheet is actually prepared to receive the sale proceeds of that business when the business is sold. It seems like a funny thing to talk about, but when you actually are working with a client selling a business and then suddenly that money lands on their balance sheet, a lot of times the balance sheet hasn't been preset to absorb that wealth properly, and it knocks the balance of this out of kilter, and therefore the money doesn't perform as well as it ought to. So there's some issues there. This client doesn't have a business, so we're going to ignore that for the moment. But their real estate, let's assume that this is not rental real estate. This is the house they live in, and they've done a great job, and they've built this house and they've paid off their mortgage, and now they own it outright. So great to have that paid off for retirement. That's a goal for a lot of people. But again, probably not going to create any cash flow unless they do one of three things. Either they sell the house and downsize, in which case they may get access to some of the value, the difference between the sale price on the old place and the purchase price on the new place, less commissions and other taxes and things.
But you know what's funny about that, Bob? Most of the retirees that I end up working with, what they do is they sell and they downsize. But what's really funny is they downsize to a smaller home, but they go into a community where the price point, they're not really getting any equity out of the house. They're just getting no mortgage. And then, right, they downsize, but they're not getting any asset out of it. They just don't have a mortgage anymore.
So true. I see it all the time. It's so true. So
which is fine, except how many retirees or pre-retirees do we talk to? And they all say, well, I'll sell the house and downsize and I'll get some of the equity out. And they 9 times out of 10 don't do that.
Where what I also see a lot is like the house I'm sitting in right now. My wife and I bought this house in 1998, and we raised 3 kids here. And it's been a great house for us. And now the kids have moved out, and we don't need this much house. We love the house, so we may stay here anyway. But if we do move out, we've already talked about what we would probably do is buy a smaller house, but something really nice, and then take the rest of the money and buy another house down in Florida, right? So
yeah, exactly.
It's not going to change a whole lot. But so a lot of times we don't get money out of here. If we do sell and if we don't sell and downsize, the other 2 ways to get cash flow here would be to rent out a few rooms on Airbnb. Like I could rent out my kids' rooms, but I really don't want strangers living in the house with me. That doesn't float my boat really. Or maybe I could make Tom Selleck happy and do a reverse mortgage, right? So there are some other things you could do. But again, for most people, this isn't a real cash flow producer. It may be somewhat of a cash flow producer, but for most people, we don't really see a lot of that.
Yep.
Then we get to this retirement money. Now, this one's interesting because today, what I'm seeing with my younger clients is I'm seeing a lot more young people getting into Roth. But a lot of our older clients, they were told, max your 401k, defer the taxes, you'll be in a lower bracket when you retire, yada, yada, yada. And the reality is that a lot of our older folks, all or most of these retirement funds are traditional IRA and traditional 401k. Nothing wrong with that. I'm not saying those things are bad, right? I have some of that myself, and most of my clients have that. But there's a couple of things that I think people need to know that they typically don't know. Most people understand that because they didn't pay, and again, to the extent this is traditional IRA, traditional 401k, most people understand that because they didn't pay taxes on this money on the way in, they have to pay taxes on the way out. Every once in a while, I meet a client who didn't know that. They're surprised by that. It's always sad when I see that, but it happens. Most people get it though. But what most people don't get, what most people don't know, and it's not because they're stupid. I mean, our clients are intelligent people. It's just that nobody ever bothered to tell them. And that is that the larger this slice of the pie is, and I'm not talking about the dollar amount, I'm talking about the proportionality of it, the relative size of this slice compared to the other slices. The larger that slice of the pie is, the higher the rate of tax they will pay in retirement. And not just on that money, on all of their money. Because what it sets up is a higher effective rate of tax. And the effective rate of tax is the rate of tax on all of our cash flow. And if this slice gets too large, it raises that effective tax rate, not just on this money, but on all the money. So we need to be paying attention to this. It's okay that they have it there. Frankly, if they hadn't put it here, they probably would have spent it, right? So I'm kind of glad to see it when we see it. But if we don't pay attention to the growth of that asset, then the overgrowth of it can cause problems for that money and for the rest of people's money. There's also three really important tax avoidance strategies that people have access to, but this money is ineligible for all three of them. So again, I can get tax avoidance if I put that money someplace else, but I can't get it if I put it here. So we just have to be paying attention. I'm not saying it's bad, but we have to be paying attention to the proportionality here. And most people aren't. They're just plowing money onto the balance sheet as hard and as fast as they can. And it's growing and building in whatever direction it grows and builds. And the odds of them getting to retirement and having an optimal proportionality by accident are zero. It's never going to happen by accident. So you got to
And
be
I
a
think
little deliberate
what's
about
occurring here, Bob, is like anytime I ask anyone, like in the first meeting, I tend to ask obviously a ton of questions. And a top question I ask is, to your point, like they're sitting and they've got a big amount of money in traditional retirement accounts. And I'll ask them, how did you choose to put that amount of money into that style of an account versus a different style of account? And I normally get the answer of, it's just what I did, it's what I was told, and it was a set it and forget it type of model.
it. Mhm.
And then I piggyback up on the question, I say, okay, so when you went through that, did you have any conversation around when you want to turn on the income stream, how you're going to get taxed on that money and how that affects all the other aspects? And that's where I get this like, oh crap moment in their mind,
Yeah.
which kind of talks into what we were talking about when we first started this episode around whole reason we're building wealth is to turn on an income stream later on. Like that's it.
Mhm. Yeah, you have to
And
be
we didn't consider taxation. Now, a lot of people think,
oh,
and you're
there's
probably
that.
about to, right, and you're probably about to talk into this. I think a lot of people think, well, I'm going to be in a lower tax bracket in retirement.
Yeah, there's I've always heard that I'll be in a lower bracket when I retire, and I always say, "Well, lower than what?" And there's this blank look on their face, and they say, "Well, what do you mean?"
Yep.
And I said, "Well, you said it. What did you mean?" And they have no idea. And I think for most people, what it means to them is that they'll be in a lower tax bracket when they retire than they were right before they retired. Now, that assumes that you're going to have lower cash flow in retirement than you had before you retired. And that's certainly not my desire. I want to have more cash flow when I retire because I want to do more of the things that my wife and I like to do because every day is going to be a weekend once I retire, right? So the days that I spend the most money are on the weekends. So I actually want to have a higher cash flow in retirement. But even if I have a lower tax rate in retirement, can I draw on my screen here for a second, Ryan? Will
Yeah,
that
you should be
show?
able to.
And
Absolutely.
I apologize to your viewers because I am not good at drawing on the screen, but we're going to give this a shot anyway. That looks so bad. I should stop there. That didn't come out too bad that time.
No, that's great.
So let's assume that this is when somebody gets out of college or just, high school, whatever, they start working. This is their first job. And over their lifetime, their income goes up. And of course, it doesn't look like this. It's just conceptually. And then they get to the end of their career and then they retire. And the assumption is that they're then going to have a lower income and therefore pay taxes during these years and in these years at the level of income they have at that time period. So this is kind of what most people think it's going to
Well, and
look
what's really funny about that though, Bob, is I always ask him, I go, well, what tax bracket are you in right now? And then they tell me, I go, okay, so what like tax brackets, do you understand how those operate? And of course, then I get blank stares again. I go, so if you're in the 22% tax bracket, whatever tax bracket you're in, if you're not below this amount of money, you might still be in the same tax bracket, even though you technically need less money in retirement.
like.
Like they don't understand the tax bracket. So you might still be in that same tax bracket, just taking less money.
Yeah, that's very possible. We see a lot of that. And the other thing is that, I did some research a few years ago. I started looking at, government statistics and whatnot on people's income and typical income streams and income progression over lifetimes. And what I found is that most people down here, I'm in a much lower bracket than I will be when I retire, right? I hope, right? I hope that I'm paying more taxes in retirement, or I have an income level that would be taxed at a higher rate when I'm in retirement than when I got my first job, right? So for most people, this period of time where they're in a lower bracket than they will be in retirement usually extends until they're in their mid to late 50s.
Yep.
So for most of their life, they're in a lower tax bracket than they will be in retirement. And it doesn't make a lot of sense to defer from a low bracket into a higher one, right? That's what we call reverse tax planning.
Yep.
Yeah. In this spot up here, obviously, it would make sense, instead of paying tax at this level, wait a couple of years and pay it at this level. So that kind of makes sense. But even when you do that, that ignores another point, which we're going to get to in a little bit, which has to do with actually managing these tax rates. So we're going to talk about managing tax rates in a few minutes. But, people plow money into these 401ks. And again, I'm not saying that's a bad thing at all, but if we're not paying attention and we're not being deliberate about it, we're probably going to end up with a suboptimal result, even if we have a lot of money. Investments. And by the way, this is also money that's typically invested in the market, which is fine. We have upside potential. That's good. We also have downside market risk. That's not as good, but we're willing to accept some risk to get the high returns. But we shouldn't have all of our money at risk. We should never have all of our money at risk. And we'll talk more about that as well. This money here is money that is also in the market. It has upside potential and downside market risk, but this money is not in an IRA or a 401k. It's not in a tax qualified plan. So this money is eligible for all three of those tax avoidance strategies I mentioned before. This money here is money that has no downside market risk. It's not in the market. Savings accounts, checking accounts, certain insurance products, CDs, money markets, that kind of stuff, where there's no downside market risk. And this money is eligible for two of those three tax avoidance strategies. So again, if this client was retiring today, and maybe we add a zero here, but my job at that point in time would be to orchestrate these slices of the pie in such a way as to create the highest possible cash flow, the lowest possible tax, make sure they never run out of money, still hit all their legacy objectives, and do all of that with minimal dependence on the market. That would be my job. But it's not easy to do if the proportionality of this is not optimal. So if I had time, if I had some runway before they retire, 5 years, 10 years, 15 years or longer, not only could I potentially help them have more money, not even through higher rate of returns, just through better efficiencies along the way, but even if they had the same amount of money, we could position it more effectively and more deliberately to create a better result. And since most people are just throwing money on the balance sheet, this thing is going to look however it happens to look when they get to retirement. It's like playing 6-card stud. You get dealt 6 cards. There you go. That's it. No draw, nothing. That's what you're dealt with. But if we had the ability to stack the deck ahead of time, we could make this look better. And, but to do that, you have to be paying attention to it. And most people simply are not. When we go back to the balance sheet, I said there's 6 things. We've talked about 3 of them. We've talked about the amount of wealth. We've talked about the protection of the wealth. A lot of that stuff lives up here. We talked about the location of it, but what's also really important is the allocation of it. So people talk a lot about asset allocation, and financial advisors talk a lot about asset allocation, and hopefully they're doing a good job of that when they're stewards of their clients' money. The problem is that the industry looks at asset allocation differently than it used to, and not in a good way. When I learned this stuff in school and, back in my college days, and when I first came into the business, asset allocation was a 3-legged stool. It was stocks, bonds, and cash. Now, you could label those in different ways, but just for simplicity, stocks, bonds, and cash. And we use stocks because that's where the highest returns are. And that's good. The problem is they're very volatile. They have ups and downs, and so we can lose money, and it fluctuates rapidly and violently every day, right? So to reduce that volatility, we put bonds in the portfolio. Bonds, by the way, also have downside market risk, but they're not as volatile as stocks. And so by adding bonds to the portfolio, we can reduce some of that volatility.
Yeah, just ask Silicon Valley Bank that question.
Yeah, exactly right. So, uh, you can lose money in bonds. You can lose everything in stocks and bonds and end up out of business like Silicon Valley Bank. Um, I mean, it doesn't generally happen to individuals. It's
It
not
still
like,
has an effect on them,
yeah.
right? Like the
What's that?
interest rate it still has an effect on them in their portfolio when you turn it on the income stream because the
Sure.
interest rates on the bonds has that same type of effect, just like Silicon Valley. They just obviously overweighted themselves and other aspects that was going on in the economy had a wave of people want their money from them.
Well, I think, a lot of people and probably I don't know their chief investment officer of that company, but probably that person had this view of, well, we'll use bonds for safety.
Yep.
And and bonds are safer than stocks, but they don't provide safety. Cash, out of the market money provides safety. So, going back to the bonds, we put the bonds in the portfolio to reduce volatility, and they do that. They also reduce the rate of return.
Yep.
So we used to call that allocation drag. That allocation drags down the rate of return, but it's measured, right? We do it on purpose. We're trying to get that balance of risk and reward in the portfolio. But we also used to use cash because you need to have some money on your balance sheet that is truly liquid money. Not only is it liquid that you can get at it, and a lot of times we can get out our investment portfolio, but truly liquid, meaning it doesn't matter the day I go to take it, it doesn't matter where the market is that day, right? So I need to have some money that is unexposed to downside market risk. And the ratio of truly liquid money versus the money that's in stocks and bonds, kind of that in the market versus out of the market ratio, varies over our lifetime. At different times, it should be different things. It's situational, but it has to do with our age. It has to do with duration of time between now and when we're going to start accessing the funds, and how much money are we going to need when we need it. Like, there's a lot of factors that go into it, including risk tolerance, by the way.
Right.
But a lot of people are ignoring that true liquidity ratio. They have all their money in the market. And I've been in the business long enough to see a whole bunch of really significant market corrections where people who were on the doorstep of retirement or already in retirement got slaughtered irrecoverably. Their
What's
lifestyle.
funny about that, Bob, is every time like 2022 and even last year, beginning of last year and beginning of this year, when the market's going wonky or the market's going down, I get slammed with new clients because all of a sudden people are like, wow, the market's not going straight up. Am I going to be okay? And this is be okay from where they're at in this, whatever stage of life they're in now, or to your point, maybe they were planning on retire in 2026. And now they're like, well, I don't know if I can retire. And the a hole in me wants to say, well, did you set up your retirement just strictly on rate of return to make or break your retirement? And then they look at me like deer in headlights, like, what do you mean? Of course, that's what everyone does. And I said, well, our financial plan isn't relying upon hope.
Yeah. Yeah, there are things that need to be done, again, because money doesn't work the same in the market in retirement as it did during accumulation. There's actually major, major differences in the way it works. I can invest in the exact same portfolio as Ryan. And if I'm retired, which I'm not, but if I was retired and you were not, that market is going to treat us differently.
Yeah.
It's just that's the way it works. Like it or not, that's the way it works. I'm not going to get into the mechanics of that here today. Um, but we do need to be paying attention to that true liquidity ratio. And again, most people are just throwing money on the balance sheet, so they're not really paying attention to it. The fifth factor is the one that just absolutely blows my mind the most, because every single person I have ever met hates paying taxes and would like to pay less. And this part is the part that focuses on taxes. And literally, I've never met a single client. I've never met a single financial advisor. I've never met a single CPA who's paying attention to this. And it has to do with the fact that every single asset that we own, when we go to take cash flow from those assets, distribute cash flow from those assets, that cash flow will have one of three types of tax treatment depending on the asset that it came from. So let me be clear here. I'm not talking about the tax treatment of the asset itself. I'm talking about the tax treatment of the cash flow that comes from the asset. And that cash flow is either going to be fully taxable, meaning we pay tax on every dollar, partially taxable, or potentially partially taxable. I say potentially because we can have money, we can have assets that have the potential to create partially taxable cash flow. But unless we're positioned properly and we know how to do it, we'll end up paying fully taxable on that cash flow rather than partially taxable. So, it can be partially taxable asset, but create a fully taxable cash flow if the client doesn't know what they're doing or isn't positioned properly.
Yep.
And most people are not positioned properly and don't know how to do it. And so they miss out on that opportunity. And then there are other assets that are going to create a cash flow that is non-taxable, no tax at all. If you think about that for a second, if you imagine your own asset base and you say, let's make a pie chart of our assets again, only this time, instead of doing locations like we did a moment ago, let's have a 3-slice pie chart. Let's take all the assets that are going to create fully taxable cash flow, and we'll make that slice of the pie red. And then we'll take all the assets that are going to create cash flows that are at least potentially partially taxable, and we'll make that slice yellow. And then all the assets that are going to create cash flows that are non-taxable, we'll make that slice green. What would you want that pie chart to look like? And everybody's going to tell me, well, Bob, I'd like it to be, all green, or mostly green. It's really not a lot of red.
Right.
And then I ask them, well, what does theirs look like? And they have no idea because no one ever showed it to them before. Now, this client, right? I don't actually have a client named Retirement Strategies, right? So this is a sample that I'm using, but it's actually built from an actual 40-year-old couple that I worked with. I rounded out the numbers to make the math easy, when I demonstrate things, but this is essentially what they look like. And this is not that unusual, for a 40-year-old couple. Maybe they're doing a little better than this. Maybe they're doing a little worse, but proportionately, it's fairly typical. And if we go back to our reports and we look at a pie chart on the taxes and we look at the distribution tax status for this client, here's what they actually look like. And that is not what they were hoping that pie chart was going to look like. This is what I refer to as, and forgive me for the language, but one of those, oh shit moments, like, oh, what did I do? Nobody wanted it to look like this. Nobody did this on purpose. In fact, I ask clients, how did it get like this? How did this happen? Did you do this on purpose? Did you visualize this and say, hey, I want to build towards this? And of course the answer is never no. I mean, the offer is never yes, that's what I did. It's always no. And so this got this way because they were doing other things, either that they believed on their own were the right thing to do. Maybe they Googled it or whatever, or maybe they had an advisor or multiple advisors tell them, or talking heads on the radio or TV telling them, you need to put money here, you need to put money there. And they did what they were told. And no one was paying attention to the impact on this pie chart from doing those things. It always reminds me of, if you ever watch late night TV, my wife and I always watch a little TV when we hop in bed at night. And, if you're watching regular TV, they have ads, right? And almost every ad that comes on, certainly every commercial break, there's an ad for some kind of medicine, some kind of miracle medicine. And they talk about all the wonderful things that the medicine does. And then they finish the ad with, oh, by the way, it could cause heart attack, stroke, rectal bleeding, death, like all these horrible things,
By the way, you could die.
Yeah, all of that stuff is happening in the background and nobody's paying attention because they're busy following the directions, And so this is not good. And the question comes up, well, all right, obviously it doesn't look the way we want it to look, but why does this matter? Well, let me show you why it matters. So if we look at the tax system in the United States, we have a graduated tax system. And probably most of the people who are your viewers or listeners to the podcast, I don't know what they call them. I'm too old to know what they call those people, but your subscribers, I guess, right?
Yep.
A lot of them probably understand this already, but I'm going to just run through it quickly anyway. The way our tax system works is, if I've got, let's just make up a number, $250,000 of gross cash flow coming to my house each year, And let's just assume for a second that it's all taxable, right? It's earned income and it's all taxable. And I know I get deductions for things, but let's just ignore tax deductions and child tax credits and stuff like that for the moment for simplicity. If all of that money is taxable and I'm married and filing jointly, then we have a married filing jointly tax table that looks like this. And we simply look up the $250,000 taxable portion on this tax table. We find it right here between 211 and 403. And that means I'm in a 24% marginal tax bracket. And a lot of people think that that means that I have to pay 24% tax on my income. And while it's true that I do pay 24% tax on some of my income, I don't pay it on all of my income. I only pay it on the money from 211,401 up to 250. So let's call that $38,500 or $38,600. That chunk, that 38 grand is taxed at 24% to create a tax of $9,264. But the chunk before it is only taxed at 22, will always only be taxed at 22. So in that chunk, I only pay 24,000 of tax only. In the chunk before that, I'm only taxed at 12, so I pay 9,000 of tax there. And in this first chunk, I'm only taxed at 10% for 2,480. So my total tax, again, ignoring deductions and such, my total tax would be 45 grand, which means that although I'm in a marginal bracket of 24, my effective tax rate is only 18.08% of the 250 that comes to my house goes to Uncle Sam in taxes. So that's the way this system actually works. And the reason that pie chart matters is because when I go to retire, let's suppose I'm lucky enough at retirement to have the same 250 of cash flow. And let's suppose it's all coming from the red slice of the pie. So it's all taxable. I'm going to be in exactly the same effective tax situation in retirement that I was before I was working. And this is the effective rate is the one that's important to people, right? Because this is what comes to my house and this is how much of it I give to Uncle Sam. That's the important ratio, rate. But what if some of the money that's coming to my house in retirement is not coming from the red slice? What if some of it's coming from the yellow slice and maybe some of it's even coming from the green slice? And so the taxable portion of my gross cash flow is not 250, it's 150. Again, I'm just making up these numbers. I just cut my effective tax rate for retirement in half. And most people don't know that you can do this. They know there's taxable and non-taxable, but nobody's really paying a lot of attention to deliberately, as in on purpose, managing their effective tax rates for retirement. When I retire, I don't want to pay a high rate of tax. I want to have really high cash flow, but I want to pay a really low rate of tax. And I have clients that are making, they have $400,000, $600,000, $800,000 a year, sometimes in the millions, and they're not paying 25, 30% tax. They're paying 5 or 6 or 7% tax, sometimes less. And it's not a loophole. It's not illegal to do that. It's very legal. In fact, these are fundamental core principles of the way our tax system was designed. It's just a lot of people aren't familiar with how to deliberately manipulate this. There are actually 3 ways to drive down that effective tax rate. Way number 1, I just demonstrated. Keep the gross cash flow the same, but lower the taxable portion. That's one way to do it. Another way to do it is to keep the taxable portion the same. Oops, I got one too many zeros there. Keep the taxable portion the same, but raise the cash flow. And we're going to get into how you do that in a minute. But if we can raise the cash flow, but still only pay tax on this money, I'm still at a lower tax rate than I would have been over here, except now I have a lot more money coming to my house. So I've lowered my tax rate by 28%. I'm paying the same amount of tax, but because I have more money coming to my house, I raised my net after-tax cash flow by 48%. So way number 1 was keep the gross the same, but lower the taxable. Way number 2 is raise the gross, keep the taxable the same. Way number 3 is do both at the same time. What if I can raise the cash flow and at the same time lower the taxable portion? Now my tax rate's down to 6%. Now I have a 64% lower rate of tax, a 50% lower dollar amount of tax, and a 60% higher net after tax cash flow, all from the exact same money, just because I was smarter about how I structured it so that I can have better distribution in retirement. These types of things actually are far more important than how much I have, because I could actually have significantly less than my next door neighbor at retirement. I don't want to, obviously. I want to have as much as I can. Again, we do our best to build wealth. But if I end up at retirement with less than my neighbor, I can still have way, way more net after tax cash flow than he or she does, simply because of better and smarter strategy. So,
And in the end, that's all we care about. We care about what's landing in our checking account after tax.
exactly right. And so we need to be paying attention to this pie chart that I showed you before. Now, when I showed you that pie chart, I showed you, here's what the pie chart looks like, at 40 years old for this client. And I have two of them here because this is what it looks like today, but what's it going to look like in the future? So this client right now, if you look at this, these current values are what cause this current chart. But this client also is earning a rate of return, and we can put whatever rates we want in here. It doesn't matter. And they're putting money away every year. So they're on a path towards retirement. We're all on a path towards retirement. Everybody is, myself included. But where is your path leading?
Yep.
And most people have no clue. They're just walking in the woods. They're just hiking, right? They have no idea where they're going to go. They don't have a map. They don't have any spot in mind. They know what it would, they'd like to find that beautiful garden with the waterfall and everything else, but they have no idea where it even is, right? They're just plowing money onto their balance sheet. So this thing's going to look however it ends up looking. Right now, if we take this and we move it forward through time, if I take this client that, let's say, I find most people are retiring at age 70 these days, not so much 65 anymore. But watch this pie chart on the right change a little bit when I click the button. So it actually got a little worse. We don't want it to get worse. We want it to get better. And so if the client stays on the path there right now, things are only heading in a worse direction. So the client needs to change course. They need to either asset shift, cash flow shift, or do some combination of the two to deliberately make this look different, right? Asset shifting simply means we take money from one place and move it someplace else, right? So if we take money that's in fully taxable and we move it to non-taxable, that's going to change the pie chart. Now, look, the reality is if I do that, it's not like it's as simple as just saying, hey, I'm going to take 100,000 out of here, make this 350, and I'm going to put that 100,000 over here and make this 105, and hip, hip, hooray, now things look better. Yes, that's true. It works, but there's considerations we have to look at along the way, right? Like if I pull 100,000 out of my 401k and convert it to Roth, I can do that maybe, but there's going to be a tax consequence. And I have to do the math to calculate what's the impact of that. So we can't do this in the blind. We have to do analysis with all of this stuff. But if we do the analysis and it shows that it's beneficial to do this, it's not hard to change this. What if I simply my wife and I logged into our 401ks at work? And again, I'm not making this as a recommendation, just as an example. What if we log into our 401k and we both click the button that says, yeah, don't put it in traditional anymore, put it in Roth? That's a huge difference in retirement. Now, obviously, I'm going to pay more tax now if I do that. And we have to take that into consideration. We have to look at all of that. But when I get to retirement, because of this, I'm going to pay a far, far lower rate of tax in retirement on the cash flow I derive from this money than I would from the money that I had before. So we have to at least pay attention to these things and do some math and try to figure out what actually creates the best result for the client rather than just blindly throwing it in there and hoping for the best. Does that make sense?
It absolutely makes sense. And this is why I wanted you, all truth being told out there, all of the stuff that Alex and I walk our clients through is from learning this stuff from you. And now we've got the tools to illustrate it. This is the stuff that's not being spoken about. This is the stuff that is getting into the weeds and understanding, like, in the end, we're all trying to we all care about cash flow. That's the only thing we care about. And we got to look at our financial planning from that perspective, not just what's my number.
Yeah, and Ryan, I don't know how much more time we have, but there's another whole area of that we have to pay attention to, which is setting ourselves up for better distribution strategies.
Yep.
And I don't know how much time I have to go into that, but there are two main distribution strategies that most people are planning to use in retirement. For their qualified money, their IRAs and 401ks and such, the plan is to take the required minimum distribution because their advisor and their accountant told them, just take the required minimum distribution, because if you take more than that, you'll pay more tax. And while it's true that you will pay more tax, that doesn't make it a bad thing. So, but they're told to take RMDs. So that's what their plan is to do. For their non-qualified money, the money that's not in an IRA or 401k, for that money, the plan is to pile it up into a portfolio, have some kind of a relatively conservative investment. We don't want too much risk in retirement, and live off the earnings. We want to have enough money so that the earnings is enough to float our cash flow. Unfortunately, as we mentioned before, if you have all that money in a portfolio, the variable nature of the portfolio is going to destroy that concept. It's probably not going to work the way the client thinks it's going to work.
Right.
And so that doesn't work real well. But that earnings distribution strategy, it's not a great strategy. It's actually a very low cash flow, very high tax strategy. There are probably another 10 or 12 distribution methods available to people, and most people are clueless as to what they are. There's like four really basic ones, that you can do what's called a linear asset pay down, which I don't know that I have time to really go into these, but it's spending an asset down can create a higher cash flow, but it can also create some significant tax advantages depending on the type of asset that it's coming from, the color, so to speak, whether it's red, yellow, or green. If it's yellow money, we can also create some really extensive tax benefits from doing that spend down strategy. We can do flat withdrawals. We can do annuitizations. We can do guaranteed withdrawals. And then there's other stuff that we can do with trusts and things like that to create cash flows, and reverse mortgages. And all of these different things have different components to them. But here's the thing: if we utilize those distribution strategies, if we design our wealth to enable them, enabling them will allow us to actually dramatically increase the cash flow that comes to our house every year, which is good, while at the same time dramatically reducing the tax we have to pay on that cash flow. So if I can take my cash flow from, $200,000 to $400,000 a year in retirement, and yet pay a fraction of the tax that I would have been paying, like maybe a quarter of the tax rate that I would have been paying, that's pretty good. And people have those things available to them, but it's all about how we structure the wealth when we're building it. If we wait until retirement day to do it, to look at this stuff, there might be a couple of little things we can do to help people out, but it's nowhere near as valuable as it is if we still have some runway left where we can work on the restructuring, the repositioning of this while they're on their way towards retirement.
So I would love to get into those incomes distribution strategies. Maybe we'll have to have you back on the podcast, Bob, to go through that. But I appreciate you coming on the show today. For our listeners, make sure you head over to the website, Built for Life, Not Just Wealth.com. And there's going to be the video to today's episode. So if you're listening to your car right now, definitely go to the website and look at the video, because I think that's going to add a lot more of the visual side of stuff that Bob spoke into today. Check the show notes inside of Apple Podcasts, Google Podcasts, Spotify, however you're listening, where you can look at the YouTube channel as well as connect with us online. Bob, thank you again for joining us. I really appreciate your time, man.
Absolutely a pleasure.
So
good luck, everyone.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License number 0K24924. Alexander Collins, CA Insurance License number 0H24806.
Robert Kievit is a registered representative and financial advisor of Park Avenue Securities and financial representative of Guardian, CA Insurance License number 0I7191, 887904 2.1, expiration date April 2028.